Hello and welcome to another video on how to secure yourself financially. So in this section and in today's video, what I'm gonna do is to make a quick recap of the beginner guide to financial statement. So this section talk about if you're able to read nutritional labels or baseball box score or soccer box score, you can learn the basic of you can learn to read basic part of financial statement. And if you can follow a recipe or applying for a loan, you can learn the basic of accounting, and the basic they are difficult. So much like when you see a CPR course, right? That it trains you to perform basic cardiopulmonary resuscitation. In this section, uh, will give you some insights about how to read this basic part of financial statement, but won't train you to be an accountant, much like the CPA course won't train you to be a cardiac doctor. However, it can give you sense and confidence when you're able to see a set of financial statement and understand them. So, after all, financial statement they show you the money. Period. From the Cuba Gooding Jr. Immortal Lines uh, of Jerry Maguire movie, yes, that where he shot out, show me the money. That's what financial statement do. Okay, and there are four type of it. The balance sheet that show what a company owns and what it owes at a fixed point in time. Okay, the TLDR of this balance sheet is a snapshot of the company assets, liabilities, and shareholders' equity, where assets are anything that a company has value, okay, whether it's intangible or intangible, liabilities, which are obligations to pay, and the shareholders' equity, which is the leftover money if the company decide to sell off all of its assets and pay off all of its liabilities. The leftover money belongs to the shareholders. So uh, generally this statement is listed using, or it's not generally, this statement use the following formula to organize the statement. Assets are equal to liabilities and shareholders' equity. So you can find that in that order, or listed with all of the asset at the top, followed by the liabilities and the shareholders' equity. So generally, the assets are listed based on how quickly that company can convert them into cash. Okay, you have current assets that a company expects to convert into cash within a year, such as inventory, or non-current assets, which will take longer than a year to convert. And also we have fixed assets that are not for sale because it allows our business to run. In obligations or liabilities, we have current liabilities, obligations that a company have to pay within a year or less. Okay, they're generally listed based on their due date. Okay, and also we have is the long-term liabilities and the shareholders' equity, which it shows is the money that the investor or the owner has invested in the company's stocks since inception, plus and minus it is revenue or losses. Okay, and then I look at the second financial statement, the income statement that show how much money a company made and spent over a period of time. The bottom line of this statement show you that. And You can think of this as a set of stairs that you start at the top, and once you go down each step down the stair, you make a deduction associated with that earning. And at the top and then at the bottom of the stair, you know if a company made a profit or not. Okay, so generally speaking, you start with the total amount of revenue, and then you deduct things like merchandise returns or discounts until you reach to the net revenue. And they call net because you can think of that as a net, as a fish net, that what left over is whatever is inside of the net. Okay, so the net revenue, after that you deduct things most of the time of the cost of sales, so how much money a company spends to produce the good and service. Okay, once you deduct that, you reach to the gross profit. Okay, and then you deduct things like operating expense, so expense that a company incur for their day-to-day activities, such as administering salaries, such as administrating salaries, or how do you call it? Administrating salaries, marketing, developing new prototypes. So once you deduct that, you reach now to the, and also you need to deduct things like the amortizations and depreciation. So after that, you reach to the net income, but then here is the operating profits before interest and income taxes. Okay, so this interests are money that a company borrow or loans that it needs to pay, where it allows to increase or decrease the income statement. Okay, so for example, money market funds can increase that or decrease. Loans that a company takes, or money that a company borrow, or money that a company lends to other business, it can increase or decrease that. And then you reach to the operating profit before income taxes, money that you own to the government, whether it's state, whether it's federal, state, local, or foreign taxes. And ultimately, you reach to the net income to see if a company actually made profit or not. Again, this is just broadly speaking. Remember, when this section won't train me to be an accountant, but it can give me sense, or can give me some confidence when I'm able to see this type of financial statement, balance sheets, income statement, and then the cash flow statement, where it reports the company inflow and outflow of cash, which is something very important because, much like natural persons, you need cash to pay its expense or to purchase assets. Okay, we're now here. Okay, this statement reuse information from the balance sheet and the income statement, and the bottom line of this show the net increase or decrease in cash. So generally, this cash flow statement review the cash from one of these activities: the the operating activities, financing activities, and investing activities. I think the order here matters. So they do this by first the operating activities, then looking at the investing activities, and ultimately the financing activities. So the operating activities, it conciliate the net income, okay, for any non-cash items that affect the statement, for any non-cash or for any cash that was used or perceived from other operating from operating activities. Okay, that's what it does. Look at the net income and conciliate with the total amount of cash that was used or perceived from operating activities. Most common operating activities can be broken down into operating assets and liabilities, where the first you have things like accounts receivable, prepaid expense such as health, vehicle, home, life, liability, disability, and long-term care such as home health care or nurse home care. Inventory is another operating asset. Intangible assets such as patents, exclusive rights to creator of or inventors in this case, exclusive right to inventors so they can distribute, so they can manufacture, distribute, and sell their invention over a period of time. For example, most notable patents that change the world, according to popular mechanics, are GPS, which was issued in 1974. These passive ranging techniques, or this navigation system using passive ranging techniques, the maglev, the electromagnetic inductive and stabilizations. So the electromagnetic inductive and stabilization system for ground vehicle issued in 1969, which allowed this maglev train electronic device, as a patent name called, which is iPhone, issued in 2007. The CRISP gene editing, this gene editing tool, issued in 2014. As well as the as well as the how do you put it? The 3G mobile telecommunications. So there is an umbrella term called the 3GPP, which is a partnership project, which is a 3G partnership project, which is this umbrella term that includes organizations that are responsible for developing and maintaining mobile telecommunication systems. So you have GSM for 2Mobile, or for 2 generations related to 2G, the UMTMS, or the, in other words, this Universal Mobile Telecommunication System, UMTS, or related 3G, the LTR, long-term evolution, and related, and it is related 4G generation, and now the 5G generation, right? So this is something interesting, by the way. Trademarks, which are unique signs or design symbols, audio that uniquely identify this competition or this company from the competition, such as Michael Buffer, okay, and it is famous quote, "Let's get ready to rumble." Copyright, which now are exclusive rights to creator of original work, sorry, so they can manufacture and distribute and sell that invention over a period of time. So for example, Coca-Cola, Twitter, Netflix, Spotify. Customer relationship, goodwill, the brand recognitions, reputations, and customer loyalty, as well as trade secrets, which is confidential data that company use to gain some competitive advantage over the process, tools, or customer list. And another common current asset, and another common operating assets are investing in affiliate, such as joint ventures like Cross and Post Malone, equity investment such as Berkshire Hathaway or SoftBank, Alphabet, Texas Pacific Group, limited partnerships, associates, and cash equivalent, which is another common operating activity. Okay, operating assets, where things like money market fund, what it does is to purchase or sell large volume of very short-term debt products, financial products such as bank acceptance, very short-term debt issued by banks, certificate of deposit, certificate of saving with short-term maturity, commercial paper, risky corporate debt, repo, government security, short-term government security, and U.S. Treasury, which is short-term debt. Short-term U.S. debt, okay, government debt, the U.S. Treasury, or Treasury bill. Okay, cool. Now, with that, okay, then I look at the most common operating liabilities, okay, like accounts payable, accrued expense, deferred revenue, income taxes payable, as well as the short-term borrowing, notes payable, and warranty obligations. Okay, so this is the first part of the cash flow statement. Okay, that's what it does. This section, look at the net income from the income investment, look at the net income from the income statement, and then conciliate that with the total amount of cash that was used or perceived for any of this activity that I mentioned before. Okay, which that's the role of an accountant. Okay, take care. And also, sorry. And also, all right. So the way how it conciliate that is, or the way how it does this is by, well, first look at the net income and conciliate with the, or look at the total amount of cash that was used, look at the net income, okay, and conciliate with the non-cash items that affect is the income statement where there is no cash involved, such as amortization and depreciations, or stock-based compensation. Something that I'm going to talk about that later. And also, okay, is to look at the net, or look at the total amount of cash, okay, that was used or perceived from other operating activities. So the second part of the financial statement, the finance investing activities, generally involve is the purchase or sale of long-term assets, such as uh, such as property, plant, and equipment, investments, intangible assets, such as patent, trademark, copyrights, that kind of thing, goodwill, leaseholds improvement as well. So this is pretty straightforward, okay? And then the financing activities that Investopedia, this media financial web service that was founded in New York in 1999, they mentioned that the financing activity focuses on how a company raises funds, okay, from investors or creditors and pays back through capital markets. So that's the whole point of this. So this section helps investors to see how the company is raising funds and where is this source of capital are coming from. So if a company cash flow comes most of the time from business operations, that's a good sign of a business investment. However, if a company is constantly raising funds from creditors or taking out of debt or issuing stock, that might not be a good sign to invest. So generally, this involves the financial activity involves the long-term liabilities and equity or ownership. So most common example is issuing equity. So for example, a company sell shares for an IPO, initially public offering. So issuing equity or emit equity, issuing debt by the company can rely on this financial instruments such as debt, corporate bonds, debentures, notes payable, repayment of debt, payment of dividends, repurchasing stocks, leasing, okay, which is when a company now gives an agreement to another company so they can use a particular assets, a vehicle or a property without taking ownership of that. Okay. And this is something fun because, for example, Uber, okay, or some of this taxi company, you know, yeah, from these taxi companies, this is a very interesting topic to discuss that because, well, things are starting to be a little bit complex in that topic. But in any case, so that's investing at financing activities. And So then I look at the footnotes, okay? And this is very important because the SEC mentioned that it is packed with information, additional helpful information. Here's some highlights. So, significant accounting principle and policies. So, at the bottom of or the footnotes, you can see what are the practice that a company must disclose, the accounting principle and practice that they have took, whether is if there has been adhered to the GAAP or the IFRS, okay, the generally accounting accepted principles generally used on U.S. company, or the International Finance Reporting Standard, which is a set of principles to make financial statement uh, consistent, transparent, and easily shareable around the globe, especially from companies that are now becoming multinational. This is something very, very important. And so knowing that, okay, so the next is, I think it's income taxes. I think it's income taxes, okay, where now here is mentioned is in a more detailed, in a more fine-grained way, uh, the taxes from federal, state, local, or foreign. Also look at the pension and post-employment programs, where with this section discuss about is this pension post employment programs, as well as if these programs are underfunded or overfunded, right? Even though a lot of people can lie about this because they can make up their financial statement, but that's another whole video, okay? And then I look at the stock options, right? Which is something that I right now, okay? So this is stock option, okay? So when I look at the stock options, okay? So stock options is a financial instrument. When we talk, this financial instrument is yeah, when we talk about financial instruments, are assets that hold some monetary value. Okay, it's an asset it's an asset or capital of package, financial instruments. Okay, so it's a financial instrument that give the owner the right but not the obligation to purchase an asset at a given price, and an agreed upon price and date. And this is very, very important, okay? Because, for example, companies issue stock options, or also known as equity options. When we talk about equity, is ownership, okay? Generally refers to ownership. So equity, what it means is, in the financial sphere, is you have assets and liabilities, okay? And once you finally pay off all of your liabilities, now what left is the equity, is the ownership of that, in theory, okay? So yeah, okay? So, and stock option is like that. It's a financial instrument, okay? Whether it's an assets or a capital of package of capital, it's a financial instrument that gives the owner the right to purchase, but not the obligation. Yeah, it gives the owner the right, but not the obligation to purchase an asset at an agreed upon price and a specific date. Okay. All right. Okay. So in other words, it's like, so if you want to explain that to a 5-year-old, where this is something important, okay? If you want to explain that to a 5 years old, which this is when ChatGPT entered the room. So ChatGPT has entered the chat. Okay. Come on, ChatGPT. What you can offer to us? Okay, stop option summary here. Now what? Stop auctions for kids. Wait, what? Did you summarize that? Stock auctions for kids. Oh my god, is summarizing is even their own query names. Okay. Okay. Explain stock options like 11-year-old kid. So imagine you have a favorite toy, okay, and your friend really wants to play with it, but you're not sure if you want to give it to them forever. Okay? So you make a deal. You tell your friend, okay, imagine you have a favorite tool and your friend really wants to play with it, but you're not sure if you want to give it them forever. So you make a deal. You tell your friend, okay, you can borrow my toy for a week, and if you still want it at the end of the week, you can buy it from me for $10. That kind of how stock options work. They're like special kind of deal between the two people, usually a company and an employee. Okay, the company says to the employee, hey, we'll let you buy some of our company stock in the future, but not right now, and we'll decide the price you have to pay for the stock later. It's funny because, okay, so the employee gets the option to buy the company stock at a certain price in the future, but they don't have to buy it if they don't want to. It is like having the choice to buy the toy after a week or not. Now let's say the employee thinks the company is doing really well and the stock price will go up. They believe the toy will become more valuable, so when the times come to buy the stock, they can get it at a lower price than what it's worth in the market. That's a good deal. But if the company is not doing well and the stock price goes well, the employees doesn't have to buy stock. It is like having, I don't want to buy the toy anymore because I can get it for cheaper elsewhere. Stock auctions are a way for a company to reward their employees and give them a chance to share in the company's success. It's like saying, hey, we value your hard work, and if our company does well, you have the chance to benefit from it. So in other words, okay, this is stock auctions. Okay. So now let me ask ChatGPT here. Summarize the text delimited by triple backticks. Okay, I'm using here some of the prompt developing engineering principles that I learned from deep learning. Okay. Okay, so stock auctions are like a special deal between a company and an employee. Okay, it is like borrowing a toy from my friends and getting the option to buy it later. Okay, borrow a toy from my friends and get the options to buy it later. The employee can buy the company stock in the future at a certain price, but they don't have to if they want to do it. If the price goes up, they can get it for less money than it worth. But if the stock price goes down, they don't have to buy it. Stock options are a way for companies to reward their employees and give them a chance to benefit from the company's success. Okay, so make it make it easy to digest, my friend. Uh, so this is a special deal between an employer and a company and employee. Okay, this is a special deal between the company and employee. So it's like borrowing a toy from a friend and getting the option to buy it later. Okay, so hey, can I see this? Can I test this? For example, it's like you having the options. Okay, it's like borrowing a toy from a friend, let's say a cell phone. Okay, and getting the option to buy it later. So the employee can buy this company stock in the future at a certain price, but they don't have to if they don't want to. Much but now in the okay, yeah, so the employee can buy the company stock in the future at certain price, but they don't have to. Again, it is a right, but not an obligation. So if the company stock price goes up, they can benefit from it. But if not, they don't have to buy it. Stock options are a way for companies to reward their employee and give them a chance to benefit from the company's success. Okay, hey, we value your hard work, and if the company does well, you have a chance to benefit from it. In theory, right? So in theory. So in theory is this. Okay. So can you describe that? The stock option is an agreement. Okay. Yeah, it's a special deal. It's a special deal between because it's a special deal between the company and the employee, where now it provides the options to the employee to buy the company stock at an agreed upon price and date, but not the obligation. So it's a way for the company to say, we value your hard work, and if our company does well, you'll have the chance to benefit. Okay. So in this stock options, okay, stock auctions, also known as equity options, okay, so give investors the right but not the obligations to buy or sell stocks at an agreed upon price and date. But again, this is a special deal between the company and the employee. Stock options, and there are two types of options: put, which is a bet that a stock will fall, or call, which is a bet that a stock will rise. Because it is okay. So put, there are two types of options: put, which is a bet that the stock will fall, or call, which is a bet that the stock will rise. Because it has share of stocks or stock index as it is underlying assets. Stock options are forms of equity derivatives and may be called equity options. Employee stock options, ESO, are the type of equity compensation given by a company to some employees or executives that effectively amount to call options. This differ from listed equity options on stocks that trade in the market, as they are restricted to a particular corporation issuing them to their own employees. So key takeaway: stock options give a trader the right but not the obligations to buy or sell shares of a certain stock at an agreed upon price date. Stock options are a common form of equity derivatives. Equity derivatives, because it has share of stocks or stock index as its underlying assets. Stock option One equity options contract generally represents 100 share of the underlying stock. And there are two primary type of options contract: calls and puts. Employee stock option (ESO) are when a company effectively grants call options to certain employees as compensation. Exactly. Employee stock options are when a company effectively grants call options to certain employees as a compensation. And they say call, which is a bet that the stock will rise. And you have these two primary type of options: contract calls, a, a bets that a stock will rise, and puts, a bets that a stock will fall. Okay. Mm-hmm. Mm-hmm. So, options are a type of financial instrument known as derivatives. A type of financial contract whose value is dependent on underlying assets, group of assets, or benchmark. Mm-hmm. Derivative can move and the company reward from the risk averse and risk seekers. Mm-hmm. Dealing with risk lovers professionally. Some advisors devote significant time to dealing with cognitive or emotional bias before engaging with a client's portfolio. Risk loving is not something to be cured or eliminated, but rather target at a portion of available capital to avoid going all in. This is, of course, where the idea of risk capital comes from. And risk seekers and risk averse. And risk averse. Risk averse investment, certificate of deposit, corporate bond, dividend, growth stocks, saving accounts. Exactly. Risk averse investment products, saving accounts, certificate of deposit, money market fund, bonds, dividend, growth stocks, permanent life insurance, risk averse investment strategy. Income investment is another strategy that focuses on holding bonds and other fixed income securities that generate regular cash flow. Advantage and disadvantage. inflation erode buying power of savings. Okay. But again, this is from the derivatives, right? So derivatives, which is a type of contract whose value depends on underlying assets, group of assets, or benchmark. Okay, so this derivative depend is on the underlying assets of that contract, or a group, in the case of the company, is on the company stocks to employees, a group of assets, whether it's gold, oil, currencies, or benchmark. Okay, an index. In this derivative, oh my god, it's like so stock options stock options options are a type of financial instruments known as derivative, where their value depend on an underlying stock, okay, or an underlying asset. Okay, for example, employee employee stock options. Okay, now refers to an underlying asset, which is the company assets in the relationship company to employee. Okay, that is one example of derivative. It can be a group of assets, whether it is currency, oil, or gold, or benchmark. Okay, Standard and Poor 500. Standard and Poor 500, S&P 500. S&P 500. Okay. So okay, so to make a recap of stock options, okay? So stock options is a financial instrument, and when we talk about financial instruments, are assets or capital of package. Okay. In this case, if this financial instrument allows the user or the owner to allow the owner the right but not the obligation to purchase a given asset at an agreed upon price and date. So it's also known as equity option, which is giving ownership. Okay, and there are two types of options: puts, which a bet that the stock will fall, and calls, a bet that a put, a bet, a put, a bet that a stock will fall, and a call, a bet that the stock will rise. Okay, and this is a form of okay, so options are a type of financial instruments known as derivative, meaning that it is on the so that the value, okay, equity derivative, in this case derivative, meaning that it's a contract. Okay, so options are a type of financial instruments known as derivatives, meaning that it's a type of contract whose underlying value rely on an asset. Okay, it can be, for example, the company stocks to employees, or a group of assets, oil, currencies, gold, or an index or a benchmark. SP, SP 500, S&P, S&P 500, for example. Okay, the Dow Jones. Holy moly, holy moly. All right, okay. So that'll be all for this video. Take care. Bye bye.